Hi students, here I will just start from where I have left in the last lecture. So if you can remember, in the last lecture I was talking about the purchase transactions under the perpetual inventory system, and there I discussed about how purchase of inventory is recorded, how freight charges are treated, and how purchase, return and allowances are recorded under the perpetual inventory system. In this lecture, I will be talking about the treatment of purchase discount, and I will be wrapping up the discussion on purchase transactions in this lecture. Here I will be talking about purchase discount. So what do we understand by purchase discount? It is a certain percentage of discount that is granted to the purchaser if they make the payment within a certain period of time. So there are different types of credit terms which will be discussed at length in the next slide. However, here we will be talking about the advantages of purchase discount. From the point of view of the purchaser, definitely it saves money, because when you avail the purchase discount, that means you need to pay a certain amount less as for the inventory. And on the other hand, from the seller's perspective, it shortens the operating cycle, because by convincing the purchaser to pay early, it can convert the accounts receivable into cash earlier. Here I will be talking about the credit terms. Firstly, we have 210 net 30, which means the buyer can take a 2% cash discount on the net invoice price if the payment is made within 10 days of the invoice date. Otherwise, the net invoice price must be paid within 30 days. So let's consider an example. Let's consider a merchandising company purchases some goods on June 1st. So according to this discount or this credit term, it says that if the payment is made within 10th June, the purchaser will receive a 2% discount. Otherwise, the total amount must be paid within 30th June. Next term is 110 EOM, which means end of the month. This means that 1% discount is available if the payment is made within the first 10 days of the next month. So let's consider that a merchandising company buys some goods on June 15th. So according to this credit term, it says that a 1% discount is available if the amount is paid within July 10th. So since the the purchase was made on June 15th, so the credit term says within the first 10 days of the next month. So here the next month is July, so it must be paid within 10th of July in order to get 1% discount. Next we have N10 EOM, which means the net amount is due within the first 10 days of the next month, which means that if a company buys some product on June 15th, then it says no purchase discount is available. However, the entire amount must be paid within July 10th. So these are the three credit terms that are there, and as we have said, in case of determining the discount, the calculation must be based on the net invoice price, which is calculated by deducting the purchase return and allowances from the total invoice price. Before getting into an example of purchase discount, it is very important that you know exactly how to calculate purchase discount. So first of all, you have to remember that discount must be calculated on net invoice price. In order to explain the calculation, let's consider a credit term 210 net 30, which means purchaser gets a 2% discount on the net invoice price if paid within 10 days. Let's consider that the net invoice price here is $3,500. So by 2% discount, we mean $2 of discount is given for every $100. So now we want to know what is the rate of discount per dollar. So we divide 2 by 100 in order to know the rate of discount per dollar. Secondly, we want to know what is the total purchase discount, and in order to do so, we multiply the net invoice price by the rate of discount per dollar. So here we multiply $3,500, which was the net invoice price, by the rate of discount per dollar, which was 0.02, and we get the total purchase discount as $70. In order to understand the purchase discount better, let's consider an example. Let's assume that Sock Stereo pays the balance due of $3,500 on May 14, which was the last day of the discount period, and the credit term was 2/10 net 30. So before getting into the transaction, we have to remember that when the buyer pays an invoice within the discount period, the amount of discount decreases the inventory cost. This is just because the companies record the inventory at the cost, and by paying within a discounted period, the buyer has reduced its cost. So this is something that has to be remembered, that the amount of discount that is given to a purchaser reduces the amount of inventory that was initially recorded as the cost of inventory. So we have to remember that whatever SOC gets as a purchase discount must reduce the inventory cost of Sock Stereo. So, and the second thing is, we have to first calculate the discount, and since the discount was 2/10 net 30, that means SOC is now eligible to get a 2% discount. And before getting into the transaction, we will have to determine what is the amount of discount that SOC will be enjoying. So in this case, we will have to base the calculation on the net invoice price, which is 3,500. So 3,500 into 2% discount comes to $70. So SOC will be enjoying $70 purchase discount just because it has paid within the first 10 days. So the next thing is how much SOC is going to actually pay for the inventory. So definitely SOC will have to pay the amount of net invoice price less the discount price. So it will be $3,430. That comes from $3,500 minus $70. So here we will have to remember that since initially when the inventory was purchased on credit, we entered the transaction as inventory debit to accounts payable credit. So now since SOC is paying for the inventory, accounts payable will have to be debited to reduce accounts payable by $3,500. And since SOC is paying cash of $3,430, so it has to be credited. As you know, when cash goes out of the business, it is credited, and because cash is an asset, and whenever asset decreases, we have to credit it. And the next term is the discount price. So as we have discussed, that the discount will be considered as the reduction in inventory cost, and since inventory was initially posted as debit entry, it has to be reduced. So we have to credit inventory by $70, which was the purchase discount. So now let's see the transaction or the journal entry. So on May 14th, we are debiting accounts payable by $3,500, which was the net invoice price. Then we are crediting cash of for $3,430, and we are crediting inventory by $70 because this is the amount of discount that SOG Stereo is getting for paying within the discount period. Now let's consider another scenario where SOG Stereo is unable to pay within the discounted period, which means that SOG can no longer enjoy the 2% purchase discount. So in this case, SOG will have to pay the net invoice price, which is $3,500. So here, as you can understand, the journal entry will be pretty straightforward because here, just because SOG is paying for the inventory, so accounts payable will have to be debited by $3,500, which is the net invoice price. And since SOG is paying the inventory in cash, so cash account will be credited for $3,500. So now if you look at the journal entry, you can see that on June 3rd, accounts payable has been debited for $3,500 and cash has been credited for $3,500. It's just because as we are paying for the inventory, so we have to reduce accounts payable by the amount that is being paid, and since cash is an asset and it is decreasing, and that's why we will have to credit it for $3,500. Here, I will be going through the transactions that had happened between SOG Stereo and PW Audio Supplies, and I will be talking about how the inventory account was impacted by all these transactions. So if you can remember, on May 4th, SOG Stereo purchased some goods from PW Audio Supplies at an amount of $3,800. So SOG Stereo, who was the purchaser of the goods, debited the inventory account as inventory got increased by the purchase. Secondly, on May 6th, SOG Stereo had to pay for the freight charges, and as they were the purchaser, they considered the freight cost as the cost of the purchase of inventory. So that is why they debited the inventory account on May 6th at an amount of $150, which was the freight charge. After that, on May 8th, SOG Stereo returned some of the goods due to its poor quality, and since the inventory was returned, inventory was reduced by $300, so it had to be credited in the inventory account. And at the end, on May 14th, SOG Stereo was able to pay within the discounted period, so it could enjoy a purchase discount of $70, and since SOG Stereo considered the purchase discount as the reduction in the cost of inventory, it again credited the purchase discount of $70 in inventory account. So this was the summation of all the purchase transactions that had happened between these two entities, and after balancing out all these transactions, the net balance became $3,580 for the inventory account. Here I will be wrapping up my discussion on purchase transactions by summing up the transactions and the journal entries that we have learned in the last two lectures. If you can remember, in case of purchase inventory account was debited and cash or accounts payable was credited. So if the purchase is made on cash, cash is credited. If the transaction or the purchase is made on account, then accounts payable is credited. In case of freight cost, if the term is FOB shipping point, then the purchaser is responsible to pay for the freight cost, and for the purchasers, it is considered as the cost of inventory. So inventory account got debited and cash was credited. In case of purchase return and allowances, cash or accounts payable is debited and inventory account is credited. In case when the purchase was made on cash, the return was made through a cash refund. So in that case, cash will be debited. However, in case when the purchase was made on account, then only the accounts payable will be debited. In case when the purchaser gets a purchase discount by paying within the discounted period, accounts payable gets debited by the amount of net invoice price, and the inventory accounts get credited by the amount of discount received, and cash account gets credited by the actual amount that is being paid. So this is the summary of all the transactions and the journals that we have learned in the last two lectures. So I hope it was easy for you to understand.